We are going to run through today some steps which you can consider prior to the tax year end, just to make sure that you make full use of allowances and reliefs, etc. So starting with the easy ones, making sure that personal allowances and basic rate tax bands are utilised. It may seem like a bit of a benign point, but we often see situations where there's married couples, civil partnerships, and one spouse is a high earner, the other spouse is a significantly lower earner or not working, and there's missed opportunity to transfer income from the higher earning spouse to the lower earning spouse to either take advantage of the tax-free 12,500 or utilise a basic rate tax band paying tax at 20% or 8% for dividends, as opposed to 40–45% for the other spouse on income or 38% on dividends. The good news about transferring assets between spouses and civil partners is that these can be done for capital gains tax purposes on a no gain, no loss basis. But obviously, for the income to be transferred, the asset has to be transferred first. So you can't transfer an asset now and pretend that the income that accrued earlier in the tax year accrued to the recipient spouse, civil partner. But yeah, good thing to do now if possible. And if it doesn't have any effect for this year, at least it's in place for 26–27 tax year. So just a reminder on the income tax bands. So thresholds are frozen until April 2031. So it means it's easy for us to remember for another 5 years, which is a good plus point. So the personal allowance is just over 12,500. You then get 37,700 taxed at the basic rate. So it takes you up to 50,270 in total, at which point the higher rate kicks in. And then we go all the way up to 125,000 where the additional rate kicks in. The basic rates of income tax, 20%, 40%, 45%, dividends, 8%, 32%, 39%. From April next year, we are seeing increases in the income tax rates for property income and for savings income, with a 2% surcharge on each band, so 22%, 42% and 47%. So again, it just sort of makes it even more important to utilise these lower tax rates, or certainly personal allowances of other spouses. And there will be an increase in the dividend rate as well. Strangely, that's going up by 2%, but only at the basic rate and the higher rate. So that'll go from 8% to 10%, 33% to 35%, but the additional rate will stay the same. I've got no idea why they've done that, but obviously it's good news for additional rate taxpayers receiving dividend income. So property is always a hot topic. We've got a lot of landlord clients, primarily because a lot of people have for a very long time treated property as a pension pot, and property is an asset class which, although Matt will probably beg to differ, has done very well for people over a great number of years. The tides are shifting somewhat with tax changes and with regulatory changes on the sort of landlord, the letting aspects themselves. But there's still a few points that are worth looking into for property business owners. A key thing here is for people who have got mixed portfolios, and by that I mean rather than just having residential property, you've got residential property and commercial property. Commercial property is becoming more and more popular for the regulatory changes around letting. So we're seeing it more and more often. Tax relief is available on borrowings to purchase commercial property. It's very much restricted on borrowings for residential property. So if possible, increase the mortgages on the commercial properties and use that cash to repay the residential mortgages. Or conversely, if you were looking to diversify a little bit, as Matt will suggest that everybody does, and you decided to sell one of your rental properties, if you sell a resi property, use that money to repay the resi mortgages rather than the commercial mortgages. Or even if you sell a commercial property, where possible, use that money to repay the resi mortgages rather than the commercial ones. That's already been covered. So the other thing with mortgage interest relief, it's very heavily restricted, as I said a minute ago, for residential properties held personally, where people have their property investments held through a limited company structure. That mortgage interest remains deductible at the corporate level. So that there are numerous benefits for individuals moving their properties from personal ownership into company ownership. Some of those are, the day-to-day tax. If you're paying 45% income tax, 47% soon to be, and you're not getting mortgage interest relief, then the tax rate's really high. If that property goes into a corporate, then potentially you're getting relief for the mortgage interest, and the company itself is only paying 25% corporation tax. Obviously, there's additional charges if you then extract the funds, but a lot of people are not using the sort of supplementary income from property portfolios to support their lifestyle. There are potential tax implications in terms of stamp duty and capital gains tax of transferring the properties from personal name into a limited company. So it's something that needs very careful attention from professional advisors such as ourselves, but it is something we've looked at for tens or more clients over the past year or so, and it is something that for a lot of people is really worthwhile. Even if you end up with a stamp duty liability, the tax savings could far outweigh that over a relatively short period of time. But as I say, the costs are potentially very steep, so the right advice is well worth having. It's not a thing to be done on a whim without consideration. Savings and investments. Again, Matt will go into detail of this, but it's just tax planning 101 at year end. Use your ISA allowances, consider EIS, SEIS, and maybe life assurance policies as a tax deferral mechanism. But I will let Matt flesh out the details of these in due course. Pension contributions. Again, there's a very fine line between sort of tax planning and financial planning with this. So Matt can give a bit more detail, but really from a tax perspective, pension contributions, are they as good as they used to be now that they're within the charge to IHT? Maybe not. Is there a benefit of doing it year to year? Certainly there is. So pension contributions, you've got annual allowance, £60,000 for this current tax year. If you haven't used it and you're able to use it, it's probably worthwhile doing so, but talk to a financial advisor who can look at full planning for you to see if you actually need it and how it might pay out for you. But yeah, and the threshold, the 60 grand, for those of you who are earning in excess of 200,000, we need to consider the tapering, and where your threshold adjusted income goes above 260, which is basically your income plus employers' pension contributions, the £60,000 threshold or allowance gets tapered down to a minimum of £10,000. So basically anyone can have £10,000 into their pension. Most people can get 60, limited to their actual earnings. So if you earn less than 60 grand, you can't put 60 grand in. So what are the other pluses? Pensions, unused allowances from earlier years can be carried forward. So if you've not been in a financial position to contribute in 24-25, for example, and you are now, you can use that utilize that unused 24-25 allowance in 25-26 tax year. So family, again, a lot of people will overlook this, but children, newborn babies can have a pension, and you can pay £2,880 a year into those pensions where they've got no income, and that will get topped up by the government to £3,600. So if you imagine doing that every year of a child's life from 0 to 18, they're going to have quite a substantial pot with good investment growth by the time they hit adulthood. And it will take a burden off them when they're looking to buy a house. They won't have to be necessarily worrying so much about saving for the future as getting money down short term for a property. Pensions, again, another point. I think everyone's probably aware of the really harsh tax rates for individuals earning between £100,000 and £125,000 a year. So another benefit of pension contributions is they extend your basic rate, additional rate tax bands, or basic rate, higher rate tax bands. So it pushes that £100,000 a bit further out, which offers good savings for that 60% marginal tax rate, which is very, very unfair, in my opinion. Gifts to charity, they don't just make you look nice, make you feel good. They can actually be good for your pocket as well. So I think most people are aware of gift aid. You donate an amount to charity, you get some tax relief on it, again, by extension of your basic rate, high rate tax bands, and the charity gets to claim an extra 25% from the government. So you pay £10, you'll get tax relief on £12.50 at your highest rate, and the charity gets £12.50 back from the government. So it's a win-win situation, really. It's also very useful for people teetering on the bracket of losing their child benefit by virtue of income exceeding £50,000-60,000. This pushes that downwards, and therefore potentially you can keep more of your child benefit. There's also, you can make donations to charity not via gift aid. If you're looking to give away substantial sums, say you've got a share portfolio, you don't need all of it, rather than in cashing and triggering capital gains and then giving money to charity, you can donate listed shares directly to charity. This has slightly different tax treatment. The charity doesn't get the gift aid top up, so the 25% top up, but you don't pay capital gains tax, and the value of those shares is deducted from your income for income tax purposes in the year. So if you earn £250,000, you give 100 grand's worth of shares to charity, your taxable income is reduced to 150,000. So slightly different mechanism to the gift aid donations. Capital gains tax, again, it's one of these things. The allowances are puny now. A few years ago, there was 12,500, £25,000 a couple. We're now at £3,000, £6,000 for a couple. So it may seem like it's not worth the faff, but if you've got a managed portfolio outside of an ISA, it's worth just selling down some shares each year to trigger that £3,000 capital gain, because all this does is it eats up the gains. Where you've got cumulative gains year on year on year on year on year, if you come to sell them in the future, you're paying tax on a massive gain, hopefully, when your investments have been managed really well by colleagues such as Matt. You're faced with a big tax bill. If you can drip out gains on an annual basis, then you're only saving future tax. And with expectation of CGT rates rising, it makes more and more sense to ensure that you do get this tax-free uplift every year, albeit on a small amount. But if we contextualize it, over 10 years between a married couple who are doing this, it's £60,000 of gains that have been eliminated from a future gain. So at 24%, that's £15,000, well, give or take £15,000 you've saved. If CGT rates go up in the future to max income tax rates, that's maybe £25,000 that you've saved for your future self. So it's a small step, but it's well worth doing. And finally, inheritance tax. Nobody likes talking about it, but for those who aren't quite ready to talk about full IHT planning, there's allowances that you've got every year that are well worth thinking about, just to get the process going and to start moving small amounts outside of your estate. So everyone has an annual exemption, £3,000 a year. You can give it to anybody, no questions asked, and that will never be subject to inheritance tax. The other plus of this annual exemption is if you didn't use your annual exemption from the previous year, you can carry it forward and use it in the next year. So if I've never made gifts before, this year I can give away £6,000. Next year I'm down to £3,000. Again, with a married couple, this is potentially £12,000 that can leave your estate before the end of the tax year and never be subject to 40% rate of IHT. Small gifts, this one's a little bit more nuanced, but this is basically intended to cover birthday presents, Christmas presents, meals out for the kids, the grandkids. So this is £250 per person per tax year. I suppose the big problem with this allowance is it's not a sort of all or part. So if you spent £300 on a single gift, that is not covered by the small gift allowance. So it has to be something that's under 250. You can't offset that 250 against a bigger gift. Weddings, everyone loves a wedding. Your kids will love you at a wedding a lot more if you give them 5k towards the cost of it. I know a lot of people do more anyway, but that £5,000 is free of inheritance tax. Again, grandkids, £2,500 free of inheritance tax. Anybody else, £1,000 free of inheritance tax. The biggie, I guess, for IHT is this gifts out of income. So there's a lot of people now who are retired, worked very hard their whole life, and they were beneficiaries of final salary pension schemes, which anybody working now is wishing they had access to. But invariably, this means that you've got massive pension income with no mortgage, dwindling costs of living, no kids to support, etc. There's often a lot of spare money. That spare money taken on an annual basis, you can give away in an unlimited fashion, so long as you have ample income left to support your day-to-day needs. The key with these is they need to be regular. Now, that doesn't mean it needs to be often. It just means it needs to be a pattern. So if once a year you give away 20 grand, then that's fine as long as there's a pattern established. It doesn't mean you need to do it on a monthly basis. But this is a really, really valuable relief. I've got clients with 6-figure pensions, which they don't need, and they're able to pay school fees for the grandchildren out of excess income, which is really appreciated and really tax efficient. So just one to consider. And that is pretty much everything that I was going to go through today. Obviously, if there's questions, please raise them and we'll cover them at the end. But I will now hand over to Matt, who can go into a bit more detail about financial planning aspects. Cheers, Matt.
Thank you, Adam, and good morning all. Thank you for joining us today. And the intention of this webinar is to give some key planning objectives or opportunities before the end of the tax year. Now, Adam has discussed some of them and touched in some of them in more detail than others, but I'm going to go into a bit more detail about how we as financial planners can support individuals and businesses before the tax year end. Now, Adam has covered a bit about ISAs, but I want to quickly recap what the current allowances are and how they will be changing going forwards. So currently, the ISA allowance does still remain at £20,000 per person per tax year. Now, it is a use it or lose it allowance. So from the 6th of April, you will have a refreshed 20,000, but if you didn't fully utilise the current tax year's £20,000, it will be lost. I say losses, you just can't carry it forwards. So it's important that should you be able to commit capital to an ISA, that you do. You'll see there on screen and recently announced in the budget that from April 2027, the allocation between cash and investments within an ISA will be changing. Now, the wording of this was stated such that at least 8,000 of the annual ISA allowance needs to be invested. Now, the effect of that is capping, well, it's putting a cap on the cash ISA at £12,000. Now, this will change individuals' investment strategy. Should they have wanted to have £20,000 in cash, they now are no longer able to do that and will have to have some invested. Now, this won't impact ISA investors over the age of 65, and we do still have a couple of years, well, 1 year actually, to make any amendments to clients' investment strategy before this is impacted. Now, there's the main stocks and shares and cash ISA allowance for adults is £20,000, but the junior ISA for those under the age of 18 is £9,000. Now, this dovetails into Adam's last point about inheritance tax. A junior ISA is a great way to support your next generation with wealth accumulation. You have £9,000 of per tax year from the ages of, well, 1 or 0 to the age of 18. Now, over 18 years, if that's invested suitably or in a high growth investment fund, then that £9,000 should be a considerable sum for when the individual does turn 18. Now, caveat about the ISA, the junior ISA is such when that individual does turn 18, the adult no longer has any control over how the individual decides to use that ISA. Should they want to go and use it for a house, that they can do that, and it may be a consideration. Further education, but should they want to buy a Lamborghini, then they may have that option as well. So it's all about education with the next generation about what the funds you're providing them are intended for. And we advocate the more conversations you have with children and grandchildren around money, the better educated they will be, and they'll make better financial decisions. The last ISA on the list there is Lifetime ISA. Now, this currently has a dual mandate, which is intended to assist first-time property buyers get on the property ladder. Now, there's a 4,000 per year allowance, which will be topped up by 1,000 to a 5,000 annual limit. Well, it's topped up by the government 25% to encourage property purchase. However, after the age of 60, you can withdraw this cash for a retirement fund. So what will be replaced in 2028 is realigning this ISA product to only benefit property purchase and not to be used as supplementary retirement savings. So that's something to watch out for as we go over the next couple of years. Now, we discussed pensions and how they may be less attractive than they used to be in previous years, given how they will be included within individuals' inheritance tax calculations from April 2027. But as Adam confirmed, it is still effective and efficient for individuals to save on a year-to-year basis. And I will just cover off now what the annual allowance for pension contributions is you have £60,000, as Adam said, as long as your relevant earnings are £60,000, then you will be able to contribute personally £60,000. Should you want to contribute more than 60 and you have the income of the relevant earnings to permit this, then you'll use the current annual allowance of 60 and then the earliest of the 3 previous tax years' annual allowances. So in this scenario you'll see on the screen, you would use the 60 from year 25-26 and then the 40 from 22-23 and so on, and then the 23-24 if you decided to commit more than that. So if an individual has been a member of a pension scheme, then you are able to use carry forward allowance. And let's say you hadn't contributed to a pension over the last 4 years or received any employer's contributions, then your allowance would still be the maximum of all 4 of these years. Combine them together and you have a total of £220,000 that could be contributed into your pension this tax year. And then when we go into 26-27, you'll have a refreshed £60,000 annual allowance. And the benefit of all this, it will offset your personal tax, extend your personal allowance that Adam mentioned. So it is tax efficient, and when invested appropriately, you can achieve some good returns over the long term and provide you with the retirement income that you need. We touched on it just briefly that they will be included within your estate for inheritance tax calculations, but the primary objective of a pension is to provide retirement income. And we've gotten used to the fact that they used to be a good wealth transfer product, but they are there intended to provide an income in retirement. And that's what the changes have made them more aligned to. Now, important to note that if you are making a company contribution, if you run your own limited business or you are receiving a contribution from your employer, well, this is more pertinent to those running their own limited business, that your year end may be end of March. So if you wanted to offset your corporation tax from a pension contribution, that would have to leave the company bank account before the end of March. And for a personal, it would have to land before the 5th of April. So there's a few days there just to be a little bit careful of and ensure that you're making the contribution in the right tax year from the business, but also receiving it personally. We've touched briefly on the changes that will be happening and changes that have been announced. Equally, this second one here, the third one I'm going to discuss is salary sacrifice. From April 2029, the exemptions from national insurance that you used to be able to receive from pension contributions will now be reduced to only the first £2,000 per person per year will be exempt from national insurance. Now, this will impact those high earners making large contributions, and it will reduce their efficiency going forwards. But it is still a efficient method of saving nonetheless. Now, I wasn't going to go into too much detail about VCTs or EISs. They both have an annual allowance as well, with VCTs having a £200,000 annual allowance and EIS having a 1 million and 2 million if it's knowledge intensive companies. Now, these products are suitable for those high earners where your annual allowance has been tapered for pension contributions, such that you have additional income that you're looking to save in a tax efficient method. Now, currently, VCTs do offer 30% income tax relief, but from 26-27 or from the 6th of April, they will only offer 20% income tax relief. So for any of those that are considering additional tax efficient savings alongside their ISAs and alongside their pensions, do get in touch and we can advise on suitable investments in a VCT or an EIS portfolio. Now, with that, I will hand back over to Kay, because that is the end of my speech. Thank you.
Thank you very much, Matt, and a big thank you to Matt, because I know he's suffering with man flu this week. And thank you, Adam. I don't have any questions that have come from the chat yet. If anybody has any questions, if you wanted to ping them in now. If not, we will finish at this point. I would remind you that obviously any advice given here today is just general advice, and you should always seek professional advice. Did anybody have any final comments, Matt, Adam, before we close?
Nothing really from me, Kay, other than to say that tax and financial planning are both very personal things, and generic advice is great, but if anyone wants proper advice tailored to them, then they should talk to us and we'd be very happy to help them.
Indeed.
Thank you very much.
Just under a month to go before the tax year end now. It's not, don't sit on your hands if you plan to make any action, but equally we can still act in time if we work together. Time's
running out fast. Thank you very much, guys. Thank you all and have a lovely day.
Thank you.
Thanks.